Welcome. My name is Jennifer Wallace, and this is my mother, Joan Grimes. And we are estate planning attorneys in Walnut Creek, California, near the Bay Area. So we're going to be talking today about what happens to the assets that don't go into your revocable living trust. So we've talked before about assets that go into your trust. If this box represents your trust, and your trust is like a box that you put your things into. So we've talked before about the things that go into your box: houses, bank accounts, brokerage accounts. What happens to the assets that don't go into your trust, the things that kind of stay out of your trust? So
This is a really important discussion to have, because a lot of times when you go to see the lawyer, you're really caught up in the stuff that's going into the box, and we don't really sometimes spend enough time with you talking about the things that are not going into your trust and what you should do with that, because it's very important. For a lot of people today, their single biggest asset besides their house is their IRAs or their 401ks.
Yeah.
So we really do want you to think about this carefully.
Okay, so let's talk about the first asset that usually comes to mind of assets that don't go into the trust are 401ks, IRAs, traditional retirement accounts. These usually are pre-tax dollars, so money that you've been putting in the retirement accounts you haven't paid income tax on yet. They grow tax-free, and then when you take the money out, you have to pay income tax on it. So we generally leave that outside the box. If you look at your statement, you'll generally notice that it just has your name at the top. It won't even usually have your spouse's name. It's just your name, IRA. So how do those go to your loved ones after you die?
So those are contracts. Okay, so that's a contract agreement. You have a contract with that IRA 401k company, and there are beneficiaries on that. So in your case, your IRAs and your husband's IRAs, because we live in a community property state, you are required to have each other as your primary beneficiaries unless the other person has waived their rights, which they shouldn't.
So my husband has me as his primary beneficiary. I know, I've checked. But if he didn't, if he wanted to put somebody else, I would have had to sign off saying that I was okay having him put somebody else, because every dollar he puts into his retirement account is half mine.
Right.
Unless you have a prenup. We don't. But that's beside the point. So if my husband dies, his retirement account will go to me because I am his primary beneficiary. Then a lot of our clients will have their children as their contingent beneficiaries. So they'll have their spouse, they'll have each other first as the primary beneficiaries, and then their children listed below, and maybe share equally or however you want to do it.
And that is a great thing to do if your children are old enough. But if your children are like Jenny's, that's 3 months, we're certainly not going to put a 3-month-old on there. And
a lot of people do, though.
Yes,
so
a lot of people, yes, we see that, and no, that's not okay. That's not okay. Because if you put someone who is not of majority age, which here in California is 18, if you put someone there, all that's going to happen is there's going to have to be a court action for guardianship and for the money to be held under court supervision, which you don't want. I mean, part of the reason that you do a trust is to avoid court supervision. So what we would like to have you do with these retirement accounts, if your children are young, is to, and in most cases, even over 18, usually we do not want children who are 18 to have millions of dollars. So we would still have the contingent beneficiary on your IRA, 401ks, annuities be the box.
For the trust.
And then once your children are old enough, depending on how old you think they're going to be able to handle it, then you can change it on your own. Yeah. And so that's what actually makes these estate planning tools really great, is that as time goes on, you can make these changes as you think your children are able to handle the money.
Yeah. So my husband and I have our IRAs with Charles Schwab. So on Charles Schwab's website, we've gone and we've updated the beneficiaries. When we got married, we added each other as the primary beneficiaries for our retirement accounts. And now our contingent beneficiary is our trust, because we have a 3-month-old daughter. And so heaven forbid if my husband and I were to die at the same time, all of the money from our retirement accounts would flow into this trust and would be held in this trust for my daughter's benefit until she turns 25. So that's what we've done with retirement accounts.
And that's the same thing we would do with life insurance too, is life insurance, you have each other spouses as your primary beneficiaries. And then when your children are younger, the life insurance flows into the trust and funds the trust, because especially for younger people, like Jenny and Taylor, her husband, is, they don't really have a lot of assets yet, and they need that life insurance to in fact fund this trust if something really were to happen to both of them, that is going to there's adequate resources to care for their daughter.
Yeah, good point. So that's life insurance. So we've talked about 401ks, IRAs, and life insurance. Another big form of retirement tools retirement tool a lot of people use are annuities. Annuities in general are used with pre-tax dollars or purchased with pre-tax dollars. Again, they're a contract right, so they have beneficiaries listed. So with annuities, we always need to check the beneficiaries. For a lot of families who have older children that are doing well and are independent and doing well.
Right.
We can do each of the spouses. So you list your spouse as the primary beneficiary, and then secondary are your children if you want to divide equally, or whoever you want to put. It's complete. As we will always say, it's your money. You do whatever you want with it. Right. So we'll say children as the beneficiaries. If you don't want to put your children, don't put your children. Put whoever you want. So those are annuities.
Another asset that we typically do not put into the trust are cars. Here in California, it's very easy to transfer cars. Most cars that are owned by married couples are owned by, you hold the title, so I hold it as Joan or Tom Grimes.
Who's Tom?
My husband.
Oh, okay.
Yeah, your dad. So that's, and even if it was just in my husband's name, if he were to die, it's very easy. There's a little form you fill out at DMV. After 40 days and 40 nights, you wait, and then you can go down there, you pay $15, you fill out the form, and you can get it transferred as long as you say you are the legal owner of this car. So cars typically do not need to go into the trust. The exception to that is expensive cars.
Yes.
Very expensive cars, because the small estate affidavit, so things you can use without a probate here in California, effective January 1st, 2020, is $166,250. So if you have a Maserati, Lamborghini, Rolls Royce, something that's very expensive, those kinds of cars typically will go into the trust. But you need to be very careful before you put cars into the trust, that you talk to your insurance company and you make sure the insurance company you have, in fact, allows cars to go into the trust, because there are different liability issues. And many insurance companies do not allow cars to go into trust. So you have to make sure. Boats are something that big boats go into trusts. If they're licensed through the Coast Guard, big boats go through the Coast Guard, and they go into the trust. And small boats that are done through DMV do not generally go in. But you can always, if you think you have an exception to that rule, talk to your lawyer just to make sure.
Yeah. Last but not least, some people intentionally don't put things into their trust. It requires some thinking and planning, but we have in the past had some people that had a trust with lots of their assets in it, but maybe they leave a house out of the trust and they own it as joint tenants, maybe with their child. So there are some forms of ownership in which they wouldn't require a probate. So for example, joint tenancy. I like to think of joint tenancy as the survivor takes all approach. So whoever is the survivor takes 100%. So
like an example would be is a lot of times we'll see parents who will help with the down payment on a house. Mm-hmm. And so they will become joint tenants because they don't want it to be part of their
family trust.
And in a lot of cases, they've done the same thing with each of their children. They've given them $50,000, $100,000. So those
are nice parents.
I know, those are really nice parents. We have people,
nice parents.
We have people who are very generous.
Wow.
And so what they'll do is they will become joint tenants with the child and sometimes they need to do that because the child won't have good enough credit to get that home loan on their own. So they will become joint tenants to facilitate that joint loan too. Even though there's other issues with becoming co-signers on home loans for your children.
That will be for another day.
I
could feel her like, oh, let me tell you. about the issues with being a co-signer.
Yes.
Be very careful.
Yes, you want to be very careful.
But we'll have a whole presentation on that.
Okay.
Or go see your lawyer.
Yeah.
Can't you just feel her anxiety of I've encouraged all these people to be co-signers. Do not become co-signers.
No, you don't want to become co-signers.
Just
unless there's a very good reason to do it.
There's other forms of joint ownership that doesn't require being in the trust, and they can stay outside the trust. But
So houses, sometimes we see that. We also sometimes see that on bank accounts where people will put their child as a co-owner. Generally, we are not in favor of you having your child as a co-owner. We would rather see that account.
Let's give an example.
Okay.
Mom, let's make you old. You are 90.
Okay.
You're looking fantastic.
Yeah, good.
You're 90, and this is what always happens. The 90-year-old mom freaks out that her children will not be able to access their money in their bank accounts to provide for their care.
That's what my mother did.
Really?
Yes, that's what she did. Absolutely. She put my sister on her bank account.
Oh, grandma. So apparently
that does really happen.
It does. It happens a lot. And so my grandmother's bank account was not in the trust. She had it outside the trust. She was the owner. And then she added my aunt, her daughter, as a co-owner on that bank account. Concerns with that. Luckily, my aunt is a very honest person. So she did not go and steal all the money and use it for herself to go shopping at Nordstrom's. She's very honest, and she did only use the money for grandma. But if you had a child, maybe
or if you had a child that had creditor problems, at the moment you put that child on the account, if they had creditor problems, that creditor could swoop in and take that money, and we would try to get it back for you, but that's a very hard maneuver to get that money back. Yeah. So you really don't want to put just a child on there, and especially if your child was having problems themselves after you die, they may not be as willing to split that money the way the trust had said. So we really discourage people from putting children on the trust, on the bank accounts
as a co-owner. So
we'd rather see them in the trust.
Yeah. I think that's a really kind of quick overview on the assets that don't go into your trust.
But if you have specific questions about assets that whether they should go into your trust or they shouldn't go into your in or out, be sure to talk to your lawyer. In or out. So thank you for joining us today. If you have other questions, you can certainly look at our website. There's lots of articles and how to reach us.
Thank you.